Good day, everyone. This is Dr. Sivaraman of iknowindices.com. So I'm presenting the tracking the forex market together webinar. It's part two of the webinar. Part one, I have given it between 5 and 5:45 GMT during the Japanese session, and I have given you the calls and also taken the positions, and you could be able to see what happened to those positions and what sort of decisions were taken, whether a buy and sell trade or a sell and buy trade, and how exactly the trading strategy was used, and then how the profit was achieved. And also we will review with regard to what happened to the initial lows and the highs which are set between 2:30 and 3:30 GMT, and what is the current situation. Then we will be able to understand how exactly the players are making use of the market and try to trap the traders, and they create the sentiment and act against the traders, and we need to invariably recognize that and trade fearlessly. And for that I will give the live market code page link, and you can open it in a browser, and I will focus the camera over that of the live market code page just for you to see how that code page looks like. You can also open it in a browser. Currently euro is trading around 1.2301 and 03. The net change is 30 pips negative. That means from that of yesterday's close it is 30 pips lower. And GBP is about 15 pips higher. It is trading around 1.4949 and 1.4953 level. And also in the case of yen, it is trading around 89.40, 89.43, about 18 pips negative net change. And in the case of CHF, it is about 40 pips negative net change. And Canadian dollar is about 60 pips negative net change. And Australian dollar has come to the positive territory. It has come almost closer to that of the high, 0.8669, 0.8672 are the current levels. 0.8679 is the high. So what happened to that of the respective crosses? Euro GBP, if you see that it has dropped further down, as I explained, that we are taking a sell position near the high, and it has come to that of 0.8225 area near the low. 31 pips negative net change is seen. And in the case of GBP yen and Euro yen, you find a nominal negative condition is seen, and they are expected to gain the levels in the case of USD yen and also Euro and GBP in this particular session. So let us review the trade what you have done during that of the. Okay, let me first focus the camera over that of the initial highs and the lows which are set for today, so that you will be able to have an understanding what happened to that market. Euro was having an initial low of 1.2297, and now you find 14 GMT, it is trading above that. During the European session, they formed the low 1.225y, and you can understand there was a drop before the rise, and the high is 1.2342, and they cut the high and formed the new high 1.2350. And in the case of GBP, 1.4919 was the initial low, and they breached and gone below to that level of 1.4859, and currently it is trading above this, and the high is 1.4947, and they have breached and formed a new high 1.4973. So you can understand how during the European session they made a slow slide, and which has created a lot of uncertainty for the traders. They thought that market is subdued and things like that. That is how they hold the market and try to induce the traders to take sell positions and subsequently gain the levels for the weekend. So we need to read them beforehand and then accordingly take positions. In the case of CHF, also they made a nominal downward move, and the high is intact, and 1.1040 is the high, and which is intact. They made only a nominal downward move and about 25 pips below that of the low. Then in the case of yen, 89.55 was the low, and now formed the new low 89.31, and currently trading around 89.43, and it is above that of 89.31, which was formed during that of the GDP data release, and subsequently they are holding it. And Australian dollar, and it breached the initial low 0.8633 during the Japanese session and formed a new low 0.8597 as a downward stopper, and subsequently it was trading around 86.11, and I was telling you that I am taking a buy position. And now you find that it has gone up to that level of 0.866. Then in the case of Canadian dollar, you find the low was 1.0417 and they breached the low and formed a new low 1.0358. Before that they made the rise and then subsequently made the downward stop band. So this is how they set the initial lows and the initial highs during the Japanese session between 2:30 and 3:30 GMT, and subsequently they breach the high, they breach the low and create the market sentiment and act against that of the traders. So let us now review. I'll minimize this particular slide and open the other slide pertaining to that of the trades what we have done during that of the Japanese session. So what happened to that of the highs and the lows I explained, and now we will see what happened to that of the trades what we are taking. So these are all the trades I proposed during that of the Japanese session. So I kept the buy limit orders and subsequently they got filled. Then I got a position at 1.2297 with an entry stop of 30 pips 1.2267 that got hedged, and subsequently I kept stop at entry and it went down to that level of 2255, and when it was rising up I kept another hedging order 2237 30 pips below and subsequently allowed the market, and around 12:30 GMT they gained the level of 1.2334 and I quickly booked a profit of 37 pips. So in the hedging I have not made any loss because I kept stop at entry. So there is no uncertainty and we know that how exactly our positions behave, accordingly we can trade. So there is no question of reading the technical analysis and see what could be the strong support, what could be the strongest support, or what could be the lifetime support and things like that. So GBP/USD, I kept a buy limit order at 1.4919 and it went up to 1.4973. And that was a clear upward stop and above that of the initial high of 1.4956, and still I have not taken the sell position because I know that they are expected to gain the levels. Otherwise, we could have taken a sell position during an upward stop during the late Japanese session and try to book profit during the drop using a trailing stop. Instead, I kept a buy order, and because it's a webinar, I wanted to prove how exactly the trading can be done. Either way, we can decide whether we can do a sell and buy trade or a buy and sell trade. If the market is near the low, we can take a buy. If the market is near the high, we can take a sell. I'll explain the basic trading strategy after this for the US session. So then I kept the 30 pips hedging order, and the hedging order got filled and I kept stop at entry, and subsequently market dropped and it came down to the level of 1.4859 and that stop was trailing, and then it got closed around 1.4865 and I earned 24 pips on the sell side. Then I kept entry stop at 1.4825 just below the market 30 pips. Then subsequently the market started gaining the levels and I was trailing up the hedging order slowly, and then once the market reached above my buy level 1.4919, I kept stop at entry, and then they quickly gained the levels after the data release around 12:50 GMT. Then I was able to close it around 49.59 with 40 pips profit. So on either side, so there is no question of bullishness involved and the bearishness involved. We use the hedging. Either you can keep stop at entry like what I have done it in the case of euro, or you can just book profit either way and keep another hedging order to limit the risk. So you cannot simply say that I have booked profit so no hedging is required, because we may anticipate the market might go up and suddenly some event can happen and it can drop. Even the players use such hedging strategy, about the hedging fund, etc. So we are not bigger than that of the big institutions. So obviously we cannot afford to trade without a stop because our equities are limited. Then in the case of USD CHF, I kept a buy limit order that got filled first. So during the process, what happened? Initially, the denominator currencies, the limit orders got filled. I kept the buy order near that of the low 1.1005, and that got filled and subsequently kept hedging order, and it went up straight to 1.1046, and I was able to close it around 1.1035 with 30 pips profit. Then hedging order is removed, obviously. Then in the case of USDN, I took a buy position, 49.45. I just modified by about 5 pips above that of the initial low was 89.41. I kept it around 89.42 and it was not filled. So after this CHF was filled, I modified by 3 pips and took a market position 89.45 and kept the 30 pips hedging order, and when market went up to 89.75, I was able to book profit at 89.70 by using a trailing stop. It's not that I know this is the high, so I booked it. It's not like that. I used to keep about 15 pips trailing stop, and once the high is not been cut for more than 10-15 minutes, then immediately I tighten the trailing stop and see what maximum I can earn out of that. So these are all the strategies, fine tuning of our strategy, which is required in order to earn from the other market. The case of Australian dollar, 86.12, I took a position. I kept a limit order and that got filled, and subsequently it came down to 85.97. The hedging order was not filled. It went up quickly to 86.65. I booked about 53 pips profit. Then in the case of Canadian dollar, 1.0418, just 1 pip above that of the initial low, I kept a buy limit order that got filled initially. Then subsequently the numerator currencies also buy near that of the low got filled. So when I keep orders like these, whichever is filled, I try to focus on those trades. If it is not filled, I'm not worried about it. I look for the next opportunity during the next session, because every session they keep on giving trading opportunities, and you have to necessarily keep stop at entry so that if the market suddenly reverses, we will not miss the opportunity. Then I booked the profit using a trailing stop around 1.0438. I got two holding positions. GBBN, I took a buy 1 pip above that of the initial low, 133.62, that was a low. Then 133.63, I kept a buy limit order, and that got filled, and subsequently it came down to that level of 133.14, and the hedging order was not filled. It has come back to that of 133.6875 now, and once it goes up, I'll try to keep stop at entry and try to book profit in that. So for the sake of the trading, I just kept the order below that. Actually, in the case of the crosses, what you are supposed to do is, whenever they make a breakout below that of the low or above that of the high, if you try to take the position and keep from there 50 pips hedging order, it will be more effective trading. In the case of yen again, euro yen, 110.07, I kept the buy limit order and that got filled, and 50 pips hedging order that was not filled. Currently it is trading below this and slightly making a loss. I'll carry over to the US session and see what best I can do on that. Still, I got a hedging order to limit the risk. Once the position makes profit, of 10-20 pips, then I'll keep the stop at entry. And certain positions, if they are not working very well, you can simply close the position with a 5-10 pips loss and forget about it, because overall what we need is a net profit at the end of the day. Then Euro GBP, I kept a sell limit order at 82.63, 82.64 was the initial high, and they made an upward stop, and above that 86.79 was the high, and then subsequently, 82.72 was the high, and the hedging order 50 pips was kept, and that was not filled, and subsequently they started dropping during the European session itself. I closed it with 27 pips profit. So after keeping stop at entry. So this is the fate of the trade. So now we will see what trades we can do with regard to the US session. Before that, let me explain to you how to take the trading decision. So we have to first of all understand the market timing. 0030 to 07 GMT is the Japanese session. 7 to 7:30 GMT is the gap time. Then European session starts by 7:30 GMT and ends by 13 GMT. Then 13 to 30 GMT is the gap time before the start of the US session. US session starts by 13:30 GMT. It ends by 20:30 GMT. I have given the and the gap time between the days is from 20:30 GMT to 0030 GMT next day. So the gap time what I am referring to, during that time the bank orders will not be pouring into the reserve market, especially with regard to the currency conversion. Then such times the players will try to use in order to make stop runs. And today is a very typical example. Between 13 to 13:30 GMT, there is a quick rise in the case of GBP. We have noticed it went up to 49.69 and then suddenly dropped to 49.39 during the start of the European US session. So gap time they make an upward stop and then subsequently drop. And so first 30 minutes there will be a slow sluggishness in that, and you can just do a gap time trade of sell whenever they are making a gap time rise and try to book, keep stop at entry once the position makes profit, and then trail down the stop and book about 30-40 pips profit. So this way also we can do a gap time trade. Now we are doing a session start time trade, so that will be a different type of trading. Now the basic trading strategy was the forex market in all six pairs, 4 majors and 2 commodity pairs. The 4 majors Euro GBP, USD Yen and USD CHF. They are the 4 majors, and the 2 commodity pairs, Australian dollar and Canadian dollar. In all the 6 pairs, you can use the live market spot page and watch the market moves, the price actions, and then 30 minutes from the start of the session. So we are now past 14 GMT. 30 minutes is over from the start of the US session, 13:30 GMT. That is the timing followed by the other players. So I am not giving what's conventionally being used by many as the Asian session, Japanese session, and all those things, and New York session, London session, European session. But actually, the timings followed by the players, if we follow the type of moves made by the players make, if you follow, we will be able to trade along with them. That is my concept. So take a sell position if a pair is near the high and not cut the high during the 30 minutes of watching, or take a buy position if a pair is near the low and not cut the low during the 30 minutes of watch. So this is how we take the trading decision. And in the case of GBP, they made an upward stop above the high 1.4973, and earlier it was 1.4971, and they made 2 pips cut and then subsequently made the drop, and currently holding around the 1.4950. So since they cut it there, we should not take a sell position. And now if you see Euro, which is closer to that of the initial low, we can take a buy position. So obviously, since GBP is also showing a positive net change after a downward move during that of the European session, they have gained the levels and there will be a short squeeze during the weekend. So we will see the forecast and also trade according to the market reading. Wherever you find it is working well, we will try to take the position. Otherwise, avoid taking position if there is no clarity in there. Then once the position is taken, whether you use the conventional charts or any type of statistical analysis, you are trying to take the position either following the pivot point or the support line and things like that. Ultimately, you cannot give the guarantee that the position will not be making loss. So obviously, we cannot accept unlimited loss. We have to keep 30 pips stop in case the hedging order is not available. Hedging facility is not available in the trading platform. The hedging facility is available, which is also known as entry stop. We can just keep 30 pips hedging order once the position is taken, as I explained it with regard to that of the Japanese session positions, and then we can keep some limit of 30, 45 or 75 pips. Once the position makes profit of 20-30 pips, we can just remove the hedging order and keep stop at entry in the original position. This is very, very important because we have to first of all avert the risk, and that is very important with regard to the money management. And if once the position makes about 2-3 pips profit, if we keep stop, then it will definitely get filled. There's no point. So once it makes about at least 20 pips profit, you can keep stop at the end. Till this time, use the hedging to limit the risk. So at any given time, you are only taking a risk for about 30 pips. So whether you trade buy euro at 1.2297 or whether you buy euro at 1.1877, it is immaterial for us. And as long as we are willing to take risk only for about 30 pips. So this particular objectivity you have to develop and inculcate. Only then you will be able to really trade without fear. And secondly, you have to understand that the players make the swings in the market after setting the initial highs and the low. So intraday moves have got the limitations. If you look into that of the long-term moves, obviously it will be confusing that they, from that of the low they rise about 700 or 500 pips in the case of euro, or 500 pips in the case of euro. So if you look into it, you might develop a bullish feel. But if you look into the long term, about 100 days or 200 days moving average, it will show that still it is bearish, because from 1.35 it has dropped and it has not recovered up to that level. So it is a question of relative comparison. Obviously, you have to do an objective trading rather than trying to become bullish and bearish. And you have to think only of a swing trade to start with. And scalping I discourage, because that makes a person impulsive. In the scalping, if you try to earn about 3-5 pips or 10 pips profit, and invariably you will be tempted to go in for more volume in order to acquire the required profit. So if you try to take about 10 lots and try to pick up about 10 pips, then probably you can pick up 100 pips. And that is how many people think, and it will make you impulsive. One good go against you, your account will be wiped out, because if all the positions make loss, then your account will erode. Instead, you can just take the entry either on the sell side or on the buy side. If you want to do that averaging, that spread the risk. And that is one of the important thing one has to learn, spreading the risk instead of taking all the position in one level as if that particular level is very, very precious. And no level is precious in the market, and they keep showing those levels. You have to keep it in mind. So first of all, you have to develop the strategy of reducing your risk to nil. Then subsequently, you can maximize the profit by using that stop as a trailing stop and taking away the limit also as a trailing limit order. There are platforms which are offering the trailing stops as well as trailing limit orders, and if you use that, then probably automatically your position will be closed with a profit, either with a limit order or with a trailing stop. So that way you can do the trading. Now let me explain, let me take the positions for that of the US session, then probably afterwards I'll explain the advantages of hedging. Those who have not attended the Japanese session, part 1 of the Tracking the Forex Market Together webinar, I'll explain it and you can understand how exactly hedging can be used. Before going into that of taking positions, let me explain the forecast, which is derived from that of the algorithm. Euro and GBP are expected to make initial swing, and then they are expected to spike up. So certainly there could be a rise or a spike, and if the volume is good, the spike might happen. Otherwise, there could be a rise at least. So let us decide what sort of trades we can take. Now, Euro is trading around 1.2295, 1.2297. It is holding here for a long time. So, we will try to take a buy position. 2.2297 with an entry stop of 36. So, we are taking the position near that of the current level, because the low which was formed 1.2255 was formed during that of the European session, and subsequently Euro is trading around that of the initial low which was set during the Japanese session, 1.2297. So we understand that what it has done during that of the European session was a downward stop and before making an upward move, and it is a weekend. So suddenly the players will just gallop the market and induce the traders to go in for a short covering, and so we will trade accordingly. Then GBP, the morning initial low was 1.4919, and they are not gone to that particular level. Currently it is available only at 1.4950 or 52. So I'll take a buy position, or I can keep a limit order slightly 2-3 pips below. But morning I kept the limit order and proved it to you that I have just got the fill. But now I want to show you how exactly we can enter into the market also. 1.4952 with an entry stop of 32. So there is no bullishness and a bearishness involved. And when we find that there is a potency for JBB to go up, we do a buy and sell trade. When there is a potency for JBB to come down, we will do a sell and buy trade. That's all. So that is how we have to perceive the market rather than giving too much importance to that other level and compare it with the other earlier level. Then that can bring in a lot of confusion. In USD current level is 1.0952. The low is 1.0950. They cut the low, which was the initial low I explained, that 1.0976. That is how I showed the live market code page. So they have cut the low and they are staying below that. So we will not try to take a sell buy position. If it stays below that of 1.0976 for more than 30 minutes, we will try to take a sell position there. So you can understand that depending upon the market position and the type of moves, how they set the initial low and the session low, and if it trades below that of the session low for 30 minutes of your observation, then we try to do a sell and buy trade, and that I call it as a technical trade. People call it as a breakout trade also. And you have to, such breakout trade, you have to close within the session. So at the moment, I am not taking any position because it is near that of 1.0950. And if that 1.0950 is not breached for more than 30 minutes of observation, we can try to take a buy position. And USD, which is showing an initial low of 189.31, they have breached and formed a new low, 89.27. And so we will not take a buy position there. If the low is not been breached, then we will try to take a buy position in our 30 minutes of observation. In Australian dollar, 0.86608, 0.8663 are the current levels. The low is 0.8597 and market is not near that. And subsequently we have seen that 0.8645, it was holding comfortably during that of the European session very frequently. Then from there it was trading around. So we will keep an initial buy limit order 0.8645 with an entry stop of 30 pips. If it is not filled in our 30 minutes of observation, then we will try to take a position in the market. Then USD CAD, it has breached the low and formed a new low, and 1.0358 is the current low, and it has come up to 1.0380, and morning low was 1.0416. If it goes above that and stays there, then we will try to take a buy. Otherwise, if it stays below that of 1.0416 for more than 30 minutes, we will try to take a sell position. So this is how we try to decide with regard to the entries. And for that, our initial lows and the highs, which are set between 2:30 and 3:30 GMT, are very important because the players follow those rules. So the same rules if you follow, then you will be comfortable. Then I have got already a position in the case of GBPM, and that is 133.63. So I'll keep here. With an entry stop of 50. So once the position shows some profit, currently it is trading around 133.50, and if it goes up, then I'll try to keep stop at entry. The going is not good, I'll just simply close it with a nominal loss because I waited for 3 sessions. From that of the late Japanese session, I have been waiting, and that got filled during the time, and European session I waited, and it was making a nominal upward move. I did not keep stop at entry at that time, and now I am still holding the position. Then Euro Yen also I am holding a position. Actually, I should have kept a stop at entry and stopped out and taken a fresh buy position. So I missed it. Sorry. Then in the case of Euro Yen, I got a buy position at 110.07. with entry stop of 50 pips. If the going is not good for more than 2 hours, we can simply close the position as well and look for a re-increase. But currently, I'm just holding it and see whether we are able to keep stop at entry and things like that. If you do not become comfortable, I'll simply close it. So there is no preciousness with regard to the positions, and if you are not able to even keep stop at entry, where is the question of that position is going to make profit in a few hours? So I do not want to wait it for a long time, and then I'll try to close it and relook at market and enter into that market. And accepting a small losses are the first step of making profit in the market. And if you avoid accepting a small loss like 10, 15 pips, then invariably you will try to close the position with a nominal profit at stop at entry, and the loss might mount if you are not keeping stop. Then invariably you will allow that loss to multiply, and later on when the market moves in your favor, you will quickly grab out 5-10 pips profit and just miss that opportunity of maximizing the profit. So always try to develop a tendency of minimizing the risk and maximizing the profit. And that is the only way by which we will be able to earn from that other market, not by any other means. And the forecast, you can derive it by any method, or even the gut feeling is fine. But the trading strategy is very important, because if we don't deploy the proper trading strategy, whatever be the type of forecast we derive, there will be an element of error involved with the forecast. Some forecast might work out about 70% or 60%. Some might work out to 80-85%. Even if it is 99% accurate, still there is an element of error of 1%. If you happen to take the position during that 1% error time frequently, then invariably you will find that it is not working for you. So, but you have failed to understand that statistics has got the limitations. That is why the standard errors are being estimated and the probabilities are being calculated in every type of statistical analysis. So you have to understand that. And also you have to keep in mind the past performance does not guarantee the future. So when you use the charts and everything, we are just relate to the past performance with that of the future. And there is no guarantee. Similar to that of the past, the future it has to move. It can show a modified move. The market dynamics might change. So you have to understand there are a lot of limitations with regard to market estimate, and still the only trading strategy, or till this trading strategy alone can help us to prevent the catastrophes. Now let me come to that of the important aspect of the trading strategy, namely advantages of hedging. In US platforms, you know that hedging is being removed. And you know in 1999 it was removed, and subsequently in 2001 it was silently introduced in the US trading platform. In 2002, then US trading platform started advertising that they also offer hedging. And we do not know why it was banned at that time. That remark by the higher authorities that if you use hedging, you do not know how to trade. That is a simple sentence by which they said hedging is nonsense and it should not be used. Then it was removed, and subsequently many of the trading platform in Europe, Australia and other countries and duty-free countries, when the platform started, they started offering hedging, and people found that in the event of the big moves in the market, they are able to really safeguard their account. And then subsequently, a lot of people started migrating to the other countries. Then US trading platforms started giving hedging silently, and again it has been reversal has happened, and now hedging facility is not available in the US trading platform, and you come across migration of the people from US trading platform to other countries. I am very sure again they will reintroduce hedging, because most of the US trading platform, if you see that they are lacking the clients. because the client can open an account and trade, and you know very well 95% of the traders lose that account and without using proper strategy, and that too when the hedging is not available, obviously the account could be closed very quickly. Then obviously they will not encourage anybody opening an account. So now we come across new strategy that you get about 100% bonus or 200% bonus and all other perks, etc. They are all being offered to attract the traders, but the protection to the trader is not being given. Now, hedging is used instead of stop. So, whatever the level in which you want to use the stop in your trading strategy, instead of hedging stop, you can use the hedging order. In case if the hedging order is filled, similar to that of the stop, if the stop is filled, obviously you lose the position. Whereas if the hedging order or the entry stop is filled, you will hold both the positions. The higher level buy and the lower level sell position will be available in your trading platform. And there won't be any extra margin for them in most of the trading platform. In such a situation, what will happen? You know pretty well in the market, there are some people who have taken the sell position, there are other people who have taken the buy position. So you can behave like a person who has taken a sell position with regard to the hedging, or just envisage the market action similar to that of the buy position, similar to that of the persons who have got the buy position. So only if you have the positions, you will be able to earn money from the market. Without positions, you have to re-enter into the market. If you are stopped out for 2-3 times, obviously I am 100% sure, however expert you might be, you will hesitate to enter into the market. That is human psychology, including the institutional traders. So they will not just like that aggressively enter, and they will become abundantly cautious to enter into the market. And if they are stopped out during the small swings, they will hesitate entering into the market during the big swing and lose good opportunities. Whereas if you use the hedging, you will be able to relate the positions with regard to the market and see whether the hedging is making profit or the buy position, original position is making profit, and accordingly you can take decisions. The hedging is used to continue the trade when the market moves in our favor. So when the position is hedged and the hedging is making profit and the original position is making loss, we can simply keep stop at entry. You know pretty well, I had done the trade of that nature in euro. Morning I had taken a buy position in euro and kept hedging order, and the hedging got filled, and subsequently I kept stop at entry in the hedging. Market came down, afterwards it reversed and closed my hedging order. Then subsequently I kept another 30 pips below another hedging order that was not filled. Then the market started going up. I started keeping stop at entry in the buy position. Then I booked a profit in the buy position also. So whenever the market moves in my favor, I'll be able to trade. And when the market moves against me, I will not just like that lose my usable margin. The hedging can be used to do either way trading. I had done the trade in the case of GBP. You would have noticed during the Japanese session. I taken a buy and kept the hedging order. The hedging got filled. I kept stop at entry. That was not filled. I'll watch for about 10-15 minutes. Only then I'll keep hedging order, stop at entry in the hedging order. How the going is by looking at the live market quote page. Then it dropped. I booked some profit with regard to the sell side and kept another hedging order to limit the risk. Then GBP started rising. I started rising the hedging order as well, correspondingly maintaining about 30-40 pips away from the market. Then once the buy position started making profit, I kept stop at entry and removed the hedging order and booked the profit on the buy side also. So if the market goes against me, suddenly I don't mind, because I'll be stopped out with the buy side with zero profit. On the sell side, I made the profit. So ultimately, profit is more important for me, and I do not bother whether euro is giving me the profit or GBP is giving me the profit. But I don't simultaneously trade in all currencies. Only for an explanation purpose, I have taken the position in all currencies to prove that how exactly we can really make money from that as a market. But otherwise, I take only one position at a time, either in euro and GBP. And once the position makes profit, I'll keep stop at entry, then expose myself to another position, depending upon the going. If I am hedged, then the hedging is making profit. I'll try to take the reverse position in another currency and try to earn from there and keep stop at entry in the original position. If the market moves in my favor, I'll continue with my original trade. So that is how we should be able to be participative whichever way the market moves. Then hedging can be used to reverse the trade when the other way going is good. When the hedging is making consistently profit for about 1 day, 2 days, that means you are against the market. You realize it. The hedging is continuously making profit, but no problem. If the original position is making about 200 pips loss, fine. Our hedging will be making 170 pips profit. Still, the acceptable loss is only 30 pips. We close the buy position and try to earn another 30 pips in the sell side, then you are at break even. If the market goes down further down, you are still happy, you are able to make the money on the downside. So you don't become panic or you don't yell at anybody and because you have got a trading strategy. Ultimately we are all entering into the market to make money. Nothing more than that. Not to talk about politics, not to talk about the economic conditions of various countries. The hedging is used to hold the position and continue trading when time permits. In the event of emergency, you can hedge and leave the trade. So suddenly after taking a position, you come across the emergency call, you need to attend to that. You cannot just like that. Leave the trade also, it becomes tense situation. You simply hedge to the market, either with 20 pips, 30 pips, money being blocked. Then after about 1 day, you are able to come back and continue the trade. You just see how the position is making, how the position is situated in relation to the other market. The market has gone far away. Then you can simply close the original position with the hedging, accepting 20 pips loss. It is similar to that of the stop. And in case if the market has moved only 100 pips away from that of the hedge position, then the buy side is making, say for example, 100 pips profit. The sell side is making about 130 pips loss. Then we just close the sell side and try to earn another 30 pips on the buy side and try to continue the trading. Then you'll be able to make money on that buy side and net profit will be seen. If 300, 400 pips away, then we just simply close with the original hedging. Then hedging can be used to close the position at any time frame instead of stop out and the position during uncertainty. That is what I explained in the previous one. If you come and look into it and the position is not viable to continue, then simply close it with a hedge. And for that, you should not continue to hedge. You have to hedge and review it in relation to that of the market moves. Then you should not be impulsive. As soon as the hedge is, you should not cut it. You have to wait at least for 10 minutes and see whether the hedging is making profit or profit and loss or continuously loss like that. Then hedging can be used to spread the risk with a limited risk in each of the positions. I explained that position traders can simply keep the buy orders. In the case of euro, suppose you are taking a buy at 1.2290, then another 150 pips below another buy order, another 150 pips below another buy order. In each of the buy orders, keep the hedging order. You just close the platform, attend to your work and come back and review it. Okay, if euro is, the first position is making profit, the other positions are not filled, fine. Market has gone up, you book profit in the first position. The market has come down and filled your second position, it is hedged, fine. Then the original hedging will be making profit and the second hedging might be making a small loss. You see how to handle the hedge after reviewing it with some time. Then subsequently, if you close the second hedging with a small loss, the first hedging is making a profit and your second buy position and the first buy position can close above their average. So you will have a net profit on that. So if you spread the risk, and there are people who have got the tendency of averaging every 10-15 pips, then that will lead to over trading. But if you spread the risk very wisely by about 100 to 150 pips, because every day they have got a limitation with regard to the market moves, about 150 pips in the case of euro, 250 pips in the case of GBP. So if you understand the risk and try to keep the orders, you will be able to trade at ease and still make phenomenal money from the other market. Then hedging can be used in the breakout trade. If you make an upward breakout or a downward breakout, then if you are taking a buy above that of the high, keep a stop or the hedging order below that of the initial high. If you are taking a sell position below that of the low, like what I explained in the case of CSM, then try to keep a buy limit order, buy stop above that of the initial low. These are all very important. Then hedging can be used without additional margin in many platforms that I explained already. If you have a buy position as well as sell position, your hedging will not attract additional margin. Instead, if you try to open two accounts, that is what most of the platforms recommend to you, and that is a misguidance. In each account, you will be paying the margin. And if the market makes a trending move for about 500 to 600 pips, one account will be closed, the other account will be making profit, and you will try to maximize the profit, wait the market will reverse, and that account will also be wiped out. Because once you lose about say $1,000 in one account, another account you will try to earn at least more than 1,000, but it is not coming, then you impatiently wait and you are not willing to accept $500 there. Instead, you wait and subsequently you find that market reversed and that account will also affect margin call. So now we can see that how exactly they are slowly forming up GBP. Okay, these are all the advantages of using hedging. The limitation of using hedging is if you do not know how to handle, then you will get struck. But it is not difficult to learn it. You don't require any scientific methods to do it. And it is a question of keeping yourself a bear as well as a bull. So keep in your mind that, okay, I am a bull when you are looking at the buy side, and when you are looking at the sell side, I have taken a short sell, and how exactly I am going to handle it. Then you just incorporate both, then you will be able to easily find that you can do either way trades without any market fear. And market is bound to keep surprises. That is part of the game because the players are got the only objective of making money from the market. Then obviously, we should also have that inculcate the habit of having only a single objective of making money rather than getting diverted with regard to the economic conditions of various countries, which does not change from second to second as the market changes. So let me just minimize. These are all the positions. You can just review how the positions are making profit or loss. GBP position is making profit. You can probably keep stop at entry. It has made about 20 pips. And Euro position is still hovering around. A little bit of losses there, so we will just wait for it. And I kept AUD a buy limit order which is not yet being filled, and it has made a small dip. Probably you can modify and take it around 55, 86.55, which will be a modified order, and keep 30 pips below that the hedging order. And with regard to GBP and the Euro yen, and they are hovering around the same level, GBP yen is slightly making profit. Then we will watch and do it. Let me just minimize the slide and take up the question. I don't think that I will have enough time to take up the questions when I see. Otherwise, you can continue to ask the questions in the blog. I will be willing to answer those questions. Because there's going to be another webinar by 15 GMT, so I do not want to take much time. Already I have reached by 4 minutes. Then GBP, new age. Why is the European session on the second hedge 40 pips away instead of 30 pips? No, sorry. It is only 30 pips, and sometimes you can keep it above 30-40 pips. There is no strict rule that you have to keep 30 pips. And if you find that they may make a little bit of stop and you can keep even 40-45 pips hedging order, there is no problem. Then, what is your trailing stop? The trailing stop, I normally use it as 15 pips. Between session change, I modify it as a 25 pips because they make a little bit of volatile move, and within the session I keep it as 15 pips. The going is good, then they will not hit me, and if they hit it, I'll re-enter into the market after watching for 30 minutes. Would you trade with the multiple lots? No, I take only one lot at a time. I don't trade multiple lots because that will lead to over trading. I know very well. I might be wise. I may be thinking that I am an expert. But if the market goes against me, then I will be looking for crisis management if you hold multiple positions, rather than you applying the strategy already developed. Okay. Rafa, what is the success rate of your strategy? I come across nearly about 90 to 95% trades closed with profit. DD, what about gold? Gold is expected to slide. Let me just read the first one. I have a buy at 49.29. Should I close it with 30%? At least you keep stop at entry, and as I explained in the previous Asian session webinar, you can do position trading by trailing 75 pips, by using 75 pips trailing stop. Wood hedging is a good to increase lot volume more than the previous place order. Not able to really get it. Then I may have missed this, but US session you would need to separate FX accounts to hedge the accounts where you CFTC regulated, correct? No, I don't have any comments with regard to CFTC, and they got that vested interest to do that. So let us not go into that. But hedging is a really useful tool, and first come first out is a very disastrous tool, but still they insist upon that. But there are a lot of protests. Let us see what happened to that. And subsequently they wanted to reduce the leverage. And these are all the tactics for the traders to pump in more money and try to take positions. But it will not work all the time. They are trying to cut the golden goose. That's all I can say. Then I was told that it is risky to open trades, example going long USD with the same base currency related to other currencies because risk will be increased. So it all depends upon how you perceive the market. You can either trade or do a sell and buy trade whenever after the rise, or you can just wait for the drop and do a buy and sell trade. Either way you can trade in the market. There is no hard and fast rule that you have to do only buy and sell trade. And balance. When the trade goes in your favor early in the session, 20-30 pips, it is tempting to take the swing trade profit. Yes, you can take swing trade profit and try to re-enter the market. Whenever they are, especially during the session start time, they will make the swings. And you can make use of this swings and earn money from that rather than simply holding your position. When the profit is seen, 20-30 profit, you know that first 30 minutes they will make swing. Try to grab the profit and re-enter into the market. No harm. And it will not lead to over trading. You will be only doing many trades. Then how many currency pairs do you advise to trade? Small traders, I advise to focus only on Euro and GBP because they give good amount of volatility. With regard to the denominated currencies like USD, Yen, USD, CHF, USD, CAD, the waiting period will be long to hold the currency positions. To book profit. If you have the patience and you have the equity, then you can trade in that. Ultimately, we are here in the market to make money. So whichever is giving a quick reward, try to trade in that. And same time, try to limit the risk. Do you think that Euro USD is reach above 1.35? There is a great potential for that next week, and probably tomorrow, Monday Asian session webinar, I'll give more of a long-term call with regard to the month end and also with regard to a new month, how exactly the market moves will be. So let me focus the camera again to that of the points of position. These are all the positions we have seen, and you can make a note of it. You can try to take positions in a demo trading platform or just do a paper trade and see how exactly they are working for you. If the strategy is working for you, you can make use of it. If you have got any doubt, you can ask me to email or through the messenger or in the blog post. So those details are right here. So I wish to take this opportunity to thank FX Street exclusively for allowing me to give the monthly twin webinars. And again, every month I will be presenting it. Then you especially for your patient listening and willing to learn the new ideas with regard to the trading. So thank you one and all. See you again. So I take this opportunity. Thank you everybody. See you again on Monday. Thank you one and all.